Good morning, or in many of your case, good afternoon, and welcome to our webinar, ERM, Responding to the Pandemic Economic Impact and Regulator Guidance. My name is Jeff Rigsby. I'm the President and CEO of CB Resource, and I will be presenting today's session. First, I do want to take this opportunity to thank you all for taking time out of your busy schedule. I know we're still in the midst of Q1 and a lot going on, and I'm sure there's probably some degree of PPP energy going on right now. So it's special that you can take this time, and I certainly respect that and appreciate it. We indicated that this session runs about 45 minutes to an hour tops, and we'll certainly keep it well within that timeline. So before we do get started, let's talk a little bit about just getting the most that we can out of the session. And if any of you do, we are using GoToWebinar, so pretty interactive. So if any of you have any questions during the course of the session, you can certainly post those, and I'll be made aware of those. We'll also have a Q&A session at the end. If you would like a copy of our presentation material, they are available. And let me just check one. Okay. They are also available. You can just shoot us an email or respond through GoToWebinar. That works as well. And there will also be a recorded version as well for any of you that may want to have that. So as far as today's purpose, pretty straightforward. And I'd like to make this somewhat conversational, but really today's purpose is to explore how enterprise risk management, or ERM, can be an effective tool to respond to both the pandemic surge or related risk. I think we can argue that the pandemic certainly brought the meaning of having a business continuity plan to life, or a disaster recovery plan to life. So we'll talk a little bit about how ERM can be an effective tool in responding to not just the pandemic conditions, which is an argument in and of itself, but also what's coming from the regulators. There's been some pretty clear guidance, and so those are the two things. Let's talk about it as a tool, and certainly what the regulators have to say and what they're looking for these days. And certainly given our time for our presentation, or my presentation today, this will be relatively high level, but it is certainly my goal to provide you with some clear takeaways and things I hope you can find useful as you get back to the office. So what are we going to cover? So let's take a look. We're going to take a look at the pandemic economic impact considerations. We'll do a pretty quick flyover on those. I think we know what they are, but let's put our discussion in context. From there, I want to talk a little bit about regulatory guidance and what we're seeing in terms of direct regulator feedback, what we're seeing in terms of communication through our clients, and many of you may already be experiencing that, but we'll talk briefly about the types of things they're looking for. And then I really want to jump into the meat of today's discussion, and it's really about ERM as a tool. And I frame that in what I like to call the 5 non-negotiable ERM disciplines and process. They're very clear, they're very concise, and as you peel back the onion on how these can serve you and your bank from a risk management perspective, and I want to really focus in on the fact that a really effective ERM system is as much about looking forward as it is about capturing what our current state of risk is. So we'll talk about what those 5 disciplines are, and then we'll do a little bit of a drill down, right? We'll look into those overarching areas, and I'll walk through some of clear deliverables that come out of that process. And then we'll go to some closing thoughts and some questions. So that's kind of our overview. So let's go ahead. Again, I'm gonna kind of hit these bullets relatively quickly. I think we know what's happened. The pandemic has hit everybody, right? It's been a national condition. It has affected our economy. It has affected the quality of our lives in many respects. It's affected many people's employment that we all know and love, and it's affected our lives in some of the most tragic ways. But the pandemic has been something that, for those of us who've been in banking, I've been in banking for over 40 years, and I don't think I've ever experienced anything quite like this. And so it's had a real broad sweeping condition. But let's take a look, peel back the onion a little bit, and see what's been going on during this period of time. I like to ask, so what can I look at that tells me the world as we know it's a little different? So I took a look at what I would call the big 3, JP Morgan, Chase, Citi, and Wells. and said, well, what are they up to, right? What are the big banks doing? And at a glance, when I looked at Q3 2020 versus where they were on their reserve levels in Q3 2019, so in a year's time, JP Morgan went from 13 billion in reserves to 30. Citi went from 10 to 23. Wells went from 9 to 19. Or stated another way, the big guys increased their reserve levels 133%, 115%, and 103% respectively. So definitely an indication that if we view these people to be kind of smart at what they do, they're telling us they're getting ready. Now, I think it's fair to say the outcome has not been as bad as any of us thought. But nonetheless, we saw some big banks doing some heavy reserving. Taking a look at the economy, it's, Moodys is a little more short and long term, kind of not very optimistic, as you can see on the right there. Their view is the upside is we have some rising equity prices is going to boost consumer spending, and that's going to be more than anticipated. And there's also, with this change of administration, some anticipation of some additional fiscal stimulus, which is viewed to be favorable. On the downside, we're coming out of the second wave of the pandemic, larger than anticipated wave of small to mid-sized failures, business failures. It's taking a hit. And the next fiscal stimulus does not necessarily provide the support we need at the government level. But on the other hand, from the conference board's economic outlook, I like these guys. They tend to do a good job. But what they're really saying is, you look as we roll into Q1, we're kind of returning. So if you look at this black center line is normal. It's kind of our beta. So all of a sudden they're kind of saying, depending where you want to subscribe to, be base forecast, downside forecast, upside forecast. Their upside forecast puts us ahead of the game coming through into Q2, which is a lot earlier than some were saying in the past. Their base case says, later in Q2, like July, and then worst case is we run out towards the end of the year. But that's kind of the economic outlook, but generally favorable. Here's where I think the world has changed as we know it, and behavior has changed. The pandemic has accelerated what I would characterize as the digitization of our world. And so when we think about our banks and we think about risk, it's affected our delivery channels. It's affected our branch life. It has changed how we deliver products and services and where our people are. It's expanded the remote workforce, and how much of that is going to continue is going to be different for each of you. But the point is this pandemic kind of forced and accelerated what was likely to happen anyway. But in a much, if you're holding Amazon, Target, or Walmart stock, you should be pretty happy. They're 5 years ahead of plan and where they thought digital adoption was going to be. But like with everything in this world, there's winners and losers, and we're seeing that surface in what the digital world has done. You can, whatever department you are in the bank, these low interest rates are not our friend, and we're dealing with them. And it's kind of funny if you think about it, with PPP coming aboard. So great fee income opportunity, great way to serve our communities. As a matter of fact, I am a big believer that community banks really rose to the occasion in first round and in the second round. If we're relying on regional banks and money center banks to meet the community's needs of PPP support, I just don't know what it would have looked like. But here's where we are. We're dealing with these record low interest rates. It's putting downward pressure on yield. It's squeezing our margins. It's forcing behaviors just because we still continue to pursue profitability. All right, so we have that. And then add that to the fact that there's a significant degree of increased liquidity, with a lot of this being people not spending money, PPP loans being funded, dropping into business checking accounts at your bank, and maybe those funds aren't being deployed. But we're also sitting on excess liquidity, which in its own strange kind of way adds to our cost burden. So with that, we're dealing with these record low interest rates, and there is some weird forces going on in sectors that may or may not recover. And these are, and in many cases, your customers. And so if you have customers in hospitality, if you have customers in retail or restaurant business, we've seen record business failures, and it's going to take some time for some of these businesses to recover. And in some cases, that recovery may not come at all. So kind of tough, right? But if we were to think about this in an ERM terms, and let's face it, I mean, we haven't gotten into policies and procedures and operating efficiencies and effectiveness and staying inside the lines, but these are the high impact things that we are now dealing with, that your senior team is dealing with, that your board is dealing with. And that is, for many, credit is going to take some form of hit, right? And so we need to watch those sectors. And as you start putting your regulator hat on, what are they thinking about, right? Not just our board, not just our shareholders, but the world in which we do our business. But credit's going to take a hit. And depending on the sectors, it could be big or small. And you may not be affected at all, and you may be affected in kind of a material way. And as we mentioned, the pandemic has accelerated everything digital. It impacts our workforce, it impacts our customer service, and perhaps even our target customers, those we serve. And certainly if you're in looking at the cyber-related risk and just the operational environmental exposure we're experiencing due to the pandemic, it just elevates our overall risk profile. Those low interest rates will be with us for a while, and if we believe the Fed from last week, it could take us out to well into 2022 and maybe even 23, and that's placing pressure on earnings, which also hampers our investments, potentially to invest in risk control. We're still stuck with a ton of uncertainty, and then this is more of a thought process just in terms as you think of what the big banks are showing us, but we're likely to see them tighten and cut costs. As a matter of fact, before we move on, I would say we're probably going to see three types of banking decisions out there, and any one of you may fall into one of these categories. But there's going to be those banks that are, oops, that's my presentation gets ahead of me. There will be those banks that are hunkering down and just trying to weather the storm, control costs, live to fight another day. And that's probably half the banks out there, according to a buddy of mine at FDIC. The next group is those that have evaluated the environment and everything looks okay. And so they're kind of staying the course. They've adjusted and adapted to the new normal, and they're going to achieve the goals they had before the pandemic hit. And then there's what I would call the people leaning in. And these are the banks that are basically, and there's probably about 20% of the banks, 2 out of 10, that are leaning into this as an opportunity. They're looking at some banks that might be hunkering down or holding back, or others maybe not seizing a moment. But just, and again, this is an ERM consideration. This is a strategic consideration. There are banks out there that are seeing this as an opportunity to surge and to grab more than their fair share. And if you're one of those banks, you need ERM too, right? Because that basically means you can potentially be elevating your risk profile, and you want to make sure whatever risk you are taking is appropriately controlled. And as we go into, and we'll talk a little bit about the regulators thing, but I'll leave you with a thought about ERM and risk in general. It's really not about risk avoidance. It's about risk control. And as we talk about risk appetite and the types of risk our banks chooses to take in order to optimally perform or achieve the level of value they're pursuing, ERM is just a tool to make sure your controls are appropriate for the level of risk you're taking, and just keep that in mind. So so the world as we know it is continuing to be uncertain. It's kind of crazy out there. We're suffering from margin compression. We have new market entrants and these fintech partnerships, different models going on. But then we have these stakeholders called regulators. And let me just share with you a couple of things that we've gotten directly from our regulatory contacts, as well as publications and feedback directly from our clients. But this is in relationship to the pandemic and what they think about from a risk management perspective and their curiosities as they come around on this next wave of exams, right? But in their mind, generally, a risk is effectively managed when you all have effectively figured out a way to identify, measure, monitor, control, and report risk, right? That is the tenets, that's the framework for good risk management. They want to see outputs that address changes. It could be in your strategy, it could be in your personnel, your operations, or just your overall outlook. So do you have a mechanism that can support that? They're looking for institutions to consider their capital levels And is their risk management system reflecting the impact of capital and what that might represent in terms of loss? And that could be a closer look at what you're doing, from a risk management standpoint, say in credit risk, interest rate risk, liquidity risk, things of that nature. Does a risk assessment appropriately take a look at your local environment as it relates to how the market is moving and the potential risk you're facing, and are you responding to those challenges? The risk assessment should place great emphasis on, well, your institution has identified and managed risk specifically to the pandemic. You have kind of a mini little pandemic scorecard. The risk assessment will provide examiners with information on how many of these changes are related to the pandemic and what you're doing about it. The risk assessment should cover full scope of how the pandemic affected your institution's operations and financial condition. And lastly, they're thinking that senior management should report to the board on what your overall risk profile is, including aggregate risk, where risk resides, kind of what that residual risk level is when you take a look at all your controls. And most importantly, how are you dealing with emerging risks? So that's kind of their world, right? So if that's what our regulators are asking us to do, let me just put a framework in. And if you have ERM, ask yourself, does your ERM process deal with these 5 points? If you're shopping for ERM, ask yourself if the program you're investing in can help facilitate these 5 points. And this is kind of an agnostic view of mine. It's my bias, but I just think this is what ERM should do, because bear in mind, over to the right there is a brief summary document of what COSO's latest definition is from an ERM standpoint in its sole purpose. There's a lot of moving parts. There's a lot of diagrams they have, but in the essence is your ERM providing the mechanism that can help you manage risk in creating, preserving, and realizing value. So, ERM's purpose is to build sustainability, to keep you center laned as risk moves through your organization. But in the end, does your ERM system contribute to the creation, preservation, and realization of bank value or organization value? So let's take a quick look at these 5 bullets, and then we'll drill down more into some takeaways of how you might be able to apply these in dealing with your own risk and what's going on with the regulators. First of all, the first component or the first non-negotiable I would say is, does your ERM system specifically articulate what your risk appetite is? Does it break it down so that you can say, by risk category, this is what I'm willing to do or not do to create value or make money? And it's really important. We'll talk about this a little later. Your risk appetite sets the framework to calibrate your entire ERM system. In today's age, we are taking on risks that we never imagined 5 years ago. So put the pandemic aside. Think about banks that are adopting new business models, partnering with fintech, getting into payment systems, vertically scaling on a local, national, regional level. These are new risks, and your risk appetite articulates what that is, and your risk assessment system should be sensitive to that. So number 1, define your risk appetite. Number 2, have a robust risk assessment system that integrates not just a series of questions that allows you to ask a question and look at where it's moving, but tie back both those qualitative points as well as quantitative data. There has to be a nexus between getting feedback on inherent risk, adequacy of controls, residual, and direction. There has to be a balance and a nexus between qualitative inputs and quantitative analysis. And those need to be merged, and they need to aggregate well. And it should, in the end, produce a risk profile. So that's number 2. Number 3, does your system call out or articulate what the top risks your bank is facing today? In this existing and post-pandemic world, I'm assuming, whether you have an ERM system or just good management, there's probably a list out there saying, given the pandemic, these are probably our 3 or 4 top risks we're facing. And I'm guessing there's something like the potential risk you might have associated with credit quality. And what's the likelihood or severity if there's weakening in your portfolio? What is that impact? What are we doing to get out in front of that? It might have something to do with interest rate environments and the margin compression and how you're responding to either surge in non-interest income, control costs, things of that nature. There might be something in there about the digitization of banking and how you're evolving to provide a safe working environment for your workforce, continue to maintain your standards of service, and continue to evolve strategically in kind of a new order. That's what top risks tell us. Not all risks are equal. A lot of risks are just people's jobs, but top risk is something an ERM system should surface. And then tracking and reporting, and for those of us that do ERM, most of that is quarterly. If you can make it more real time, that's great. But minimally, does your tracking and reporting system, does it report out quarterly? And does it generate the type of information that can either stimulate good dialogue around risk or even move to better decision making? But if all we're doing is dumping a bunch of data into some sort of reporting mechanism and it's not filtered in a useful fashion, it's not serving you well. And then my fifth component of the non-negotiables is the whole system should be manageable, right? Hopefully it's leveraging technology. Hopefully you have some subject matter expertise and there's an efficient way to deliver this. What we don't want to become is slaves to a system that's not serving us. And that's easy to do in an ERM environment. So you want to adopt an ERM system that is appropriate for your bank's business model and the level of risk you're managing and the level of resources you have to support it. So that's kind of the five non-negotiables. And I'd like to spend a little time and talk about that, but just to think about things in flow charts. We're kind of wonks and junkies around here for how things move. And by the way, I'm going to be talking about ERM in this case from a top-down standpoint. There's top-down ERM, there's bottoms-up ERM. They both serve very important roles. I think when we look at the pandemic and regulatory interest, which is kind of the focal points of our session today, I like top-down. Top-down supports our ability to synchronize our risk priorities and tie it back to performance. And we'll get into that in a little bit as we talk through the process. But as you look across this flow chart, think about these green boxes as the front end. That's where you're kind of calibrating your ERM system, right? And you're talking about what's your strategic intent, what's your capital position, which allows you to frame your risk appetite, which allows you to adopt governance like policy. You know, what is your ERM policy? What is your charter? Things of that nature. That all happens at the kind of the tip of the spear. But then we roll into that identify, measure, monitor, and control risk process. And I'm going to say this about ERM. You can have the coolest, slickest dashboards, technology, and all that stuff. And it could look good. It could feel good. It could be whatever. But if you're not fostering dialogue, and if that technology is not supporting a process, it's not doing what it's designed to do. Nobody says ERM is a technology platform. COSO's definition of ERM is it is a process. And it is a continuous, systematic process that gets better over time. So challenge whatever systems you adopt to create dialogue, to stimulate interest, to elevate risk awareness in a useful manner, right? So when you think about the process, identify risk, that could be your assessment platform, right? What's, assessing your inherent risk, or if you're an OCC bank, your quantity of risk, your quality of risk management, your aggregate risk, your direction of risk, or inherent risk, adequacy of risk management, residual risk, direction of risk. That's your framework, right? That's the model in which you want to filter this information. But I'm going to talk more from key risk category perspective. There's a lot of ways to slice that data. You can do it by operations or departments or things of that nature, but minimally, I think a framework should still roll back up to key risk categories. And those could be things like credit risk, interest rate risk, liquidity, price, operational risk, compliance risk, strategic risk, reputation risk, cyber. If you have strategic business units like mortgage, trust, insurance, you may be in payments. If you happen to be a mortgage platform these days, that could be awesome because some of you out there that are scaling up mortgage, it's probably been your salvation over the last 12 months. I mean, there's money to be made on the mortgage side. But anyway, developing that system, that enterprise risk assessment system that really frames what it is you want to evaluate and have it sequentially roll up to a dashboard. Secondly, measuring risk in our world is really about quantifying the nature of the risk itself. Not all risks are equal. So your measurement system should help you support kind of driving to that item I mentioned earlier about top risk, right? What are my top risks and how likely are they to occur? If they were to occur, how severe would it be? Where does the risk reside? What do my current controls look like? Is the residual risk unsatisfactory? And do I need to have a plan in place to mitigate that risk? That's kind of part of your measurement process. Monitoring is just answering the question, who gets what and when, right? Again, what a board member sees, what a senior management team sees, what a line manager sees is always going to be dialed slightly differently. But creating those monitoring systems or dashboards that speak to the audience and provides that ability to stimulate dialogue or to make better decisions. And then lastly, if you've done that, that sets up your control system, right? That allows you to modify your behavior or adjust controls given the climate. And ERM is all about tracking the movement of risk and trying to anticipate where it's going. You know, if you think about it, you're adopting a process that's a continuous process. And through that, it gets better over time. It's like practicing, right? You just get better over time. If I were to drop these in a roadmap and say, hey, these are the 5 non-negotiables, how does this feed back to the point of our discussion today about enterprise risk regulatory expectations in an ERM platform? Here's kind of my 5, and here's some key comments that the regulators had cited that they're interested in, right? So how does my risk appetite serve me in dealing with one regulatory requirement, which is the output should address change in strategy, personnel, ops, and outlook? Guess what? A risk appetite frames that discussion. It indicates what level of risk you're taking, where, and how. So it's a responsive tool in that regard. When you think of your risk assessment itself, that really sets you up to provide the institution's capital levels must be considered given losses or potential losses from the pandemic. You know, take a closer look at credit or interest rate risk or those other factors. But the risk assessment should dial into an output that provides them to insights as to how you're monitoring, tracking your risk, and how you're responding to it. It should also discuss how the local conditions are affecting the bank. What are those challenges? What are you doing to present responses to those challenges? As far as top risk mitigation, which I think is what regulators are primarily interested in right now, is the risk assessment should place great emphasis on how well you've identified these risks and then set up a means to respond to them and manage them. And that's what that third module does. It should also, the risk assessment should provide examiners with information on how any of these challenges of the pandemic are being addressed, right? So that's that output, that top risk. Tracking and reporting, pretty straightforward, right? It kind of lets them know how you're looking at things. And then manageability, you know, senior management should report to the board and overall have a risk profile, including aggregate emerging risk. The system needs to be manageable enough so as you aggregate information, it can be used appropriately. Okay, so let's spend the balance of our time talking about each of these 5 components. And, you know, I think all of these things could be done, and you may be doing them already. You may have a system in place, but let's talk a little bit about what it looks like to actually do it, or what the outputs look like and why we're doing it. So let's kind of walk down that lane. And if you remember, when we talk about risk appetite, and when I think of risk appetite, I think of it in terms of, I want to see a heat map. I want to see how much risk I'm willing to take by where that risk resides. So the definition of risk appetite is the level of risk your bank is prepared to accept to achieve your financial and strategic goals and objectives. I mean, that's what it is. And your risk appetite should really set a clear direction, strategic direction where you're going. If you really think about it, your strategic plan should say what your risk appetite is. It just may not have a heat map, but it does articulate your intent. Your risk appetite should reflect that. But think about it this way, your risk appetite, if you own risk, if you're the CRO, or if you're the designated risk owner, don't you want something that serves as a blueprint to calibrate your enterprise risk management system to reflect where the greater risk resides? Not all risks are equal. But anyway, build that heat map, and let's talk about what that looks like. I see 3 primary outputs of a risk appetite process. So number 1, if you go back and you want to do this exercise yourself, grab an Excel spreadsheet and take a heat map like this, lay out your key risk categories, and start asking questions about the level of risk you're willing to take. And there's different debates on risk appetite, but I'm going to tell you that risk appetite is all about your intent and what you're willing to do. In some banks and some management teams get really comfortable at what they do and they execute it at the highest level, and they fail to start recognizing that it still has risk. So if you're growing at a double-digit rate, if you're doing bank acquisitions, if you're going down a fintech partnership, if you have a payments platform, if you're vertically concentrated, I have regional SBA lenders that run 800% concentrations and they think that's normal. It's not. So as owner of risk management for your bank, and as you think about, particularly in a pandemic environment, talk about risk as it relates to what the risk is, not to how well you control it. That's your risk profile. Risk appetite is recognizing some things you do might have a higher level of risk exposure, and you need to capture that, and you need to articulate it, right? So think about that in your heat map. So if you've laid it out by risk category, and let's talk about compliance. There's a good one. So what is my risk appetite and compliance? Well, if I'm pretty much a commercial bank and I just serve businesses and I stay inside my lane, I'm guessing that my risk appetite and compliance is relatively kind of low, moderate. I don't have any consumer exposure. I'm not doing any kind of new age business. So I'm kind of staying in my lane. Maybe I'm starting to inch into online banking or something. But on the other hand, what if you're looking at expanding into a broad range of online consumer related products? What if you happen to like MSBs or you want to bank a bunch of casinos? What if you want to get into the cannabis related businesses? What does that do to your compliance risk appetite? And if you tell me that your compliance risk appetite is moderate, think again. Because if you're getting into MSBs or other businesses that just inherently require a greater degree of risk management or BSA support, that should be reflected in your risk appetite. And so to me, that's an example. If you run high concentrations in credit, that should be reflected in your risk appetite. If you take certain risk associated with risk tolerance levels, if you run lean on liquidity, if you are investing hand over fist to develop a digital bank, whether you call out IT as a standalone credit risk area or if you lump it into operational risk, but you're racing to develop a digital bank platform, don't tell me your risk appetite in operational risk or IT risk is moderate. It's not. You're venturing into things that elevate your overall risk you're taking, and ERM's job is to ensure the controls associated with that risk taking are appropriate. Okay? So I might have beat the drum on that one, but it's really, to me, I do a lot of strategy work, and I also happen to be an audit committee chairman at a bank in the Midwest. And in understanding and calibrating our control systems, the level of risk we're taking is where this game starts. And that, to me, is risk appetite. So you build your heat map. You write risk appetite statements that just explain it more clearly as to why it is what it is. So if it's moderate high, tell me why it's moderate high. And tell me a little bit about your controls. So that's the second piece of risk appetite. The third piece is tell me what your risk tolerance levels are in each area. And you guys, this is easy stuff, right? This is taking an Excel spreadsheet, taking your key risk category. And by the way, I'm not into necessarily, if you want to hire a company like ours or anybody else so you're not using Excel spreadsheets, great. They're still useful. But that third piece of your risk appetite is all about your risk tolerance levels. So look at credit risk and come up with what you think those key risk categories, call them KPIs, if you will, key performance indicators, call them key risk indicators. I'm agnostic on that stuff. They're measurements, right? They're metrics. But figure out what those are and decide what low to high looks like. So if you're, and your risk appetite is going to be somewhere along that low to high spectrum. But when you hear the term risk tolerance, this is where it comes into play, right? So take some time, get with each of your risk owners by risk category, and see if you could come up with what the KPIs are, or the KRIs, in each of your key risk categories. And what's different about this, for those of you that are familiar with your ERM platform and you're doing risk assessments, it's one thing to ask a bunch of questions and get answers. But when I'm talking about operational risk, okay, I've got my good enterprise risk assessment that's telling me my inherent risk operationally might be, moderate high. My controls are strong, acceptable, and my residual or composite risk is moderate. My direction is increasing. I've got a bunch of granular information that talks about that. But what are the metrics that indicate what my tolerance levels are? Like fraud activity or ACH activity or wire transfer activity, things I can measure and report that bring that quantitative perspective to the qualitative risk I'm managing. But those are the three takeaways on risk appetite. So that was non-negotiable number one. Number two, non-negotiable, good risk assessment system. Again, you can build it yourself. You can buy one. Not really, I like ours. But here's 3 or 4 points I want to make about a risk assessment system. It should be really intuitive and easy to use. And hopefully you're not becoming a slave to the system. It should be a mechanism that provides you good qualitative feedback in the areas that are traditional to good enterprise risk management, right? So, and it should have risk appetite out at the front end, but typically what we're looking at is inherent risk, adequacy of risk management, composite or residual risk, direction of risk, OCC, quantity of risk, quality of risk management, aggregate risk, direction of risk. But you want a system that creates a hierarchy, right, of risk categories, so I guess what I would call risk categories. And you can choose CAMELS as a framework. You can use risk categories as a framework. Adopt a framework is all I'm saying. And that's all your assessment stuff, right? That's involving risk owners and their team members to tell us what's going on in a semi-granular way of what our risk exposure is and what our controls look like. The other piece that you want your system to do is see if you can also capture quantitative, right? Get those things, those KPIs, KRIs that tell you how you're doing against your key risk categories or KRIs, I should say, and how you're moving across the spectrum or your tolerance continuum and what's the direction. So if your system is just giving you qualitative feedback from what your assessment feedback is, that's good stuff. And I think most systems out there now are helping you develop dashboards around quantitative, but there needs to be both, right? And as you look at each of those key risk categories, and this doesn't do the job yet, and I'll speak to it in a minute, but I want to make a couple of points here. Again, I've talked about risk categories or business lines, and there could be drilled down. So when we talk about operational risk, we know that beneath that, there's things like internal and external fraud and employee practices, workplace safety, professional obligations involving clients, products, businesses, physical assets, business disruption and system failures, things of that nature, and compliance certainly has all the other things. So you do want a dashboard that kind of can get granular enough to tell you where the risk resides in how it's moving. But this is just one element of it, right? But you do want a hierarchy that can help you get a good sense of movement. I think most systems do that. And I guess the challenge I have is I can only ask a question so many times and expect it to move so many ways. So there's also that. Well, I'll come back to the kind of the quantitative piece. Get granular where you need to. And most of you that have an enterprise risk assessment, it's asking you a question about a key risk consideration, and you're probably answering in response to kind of an inherent risk question or your adequacy of risk controls. I'm gonna pose one additional challenge to your system, or at least I want you to think about as you get into risk assessments, and especially when we think about the pandemic, is find a risk assessment system that not only drills down to those key risk categories and in those subcategories and those subcategories. Again, I'm kind of a top-down person, so I tend to stop at a certain level and assume certain controls are being done. Bottoms up comes at it a different way. Start looking at asking the question, though, is at the point in time that you're answering the question, where is that risk going? Not just how that question compares to what you answered before, because we're kind of using that as a trend line. But isn't it more important at the same time to ask the question, where is this risk going? And so I ask each of you as you go back to your risk assessment systems, or if you're evaluating a risk assessment system, determine whether or not if it's asking you where that risk is going. Because remember, ERM is about anticipating or identifying emerging risk and threats. If all we're doing is asking a question to see if we're improving our controls, that trend has given us a trend line on improvement or not improvement of a given control factor. It's not telling us where that risk is going in the sense of what you anticipate. A real simple example of that is you could be answering a question about banking ops in any number of ways as it relates to day-to-day operations. But let's just say you're scheduling a conversion 6, 9 or 12 months down the road. Doesn't that need to be captured? Because just because the control looks good, really good today, shouldn't we identify right at that point in time we need to be resetting things in our risk assessment system that knows that 12 months from now we're going through a systems conversion, or we're launching a new online product, or we're expanding into some sort of fintech thing? It's your risk assessment needs to ask you what's going on in the future, not just what you just did. And so I encourage you to challenge your system that way. And by all means, and most systems don't come with this. This means this is an external buy you have to make, but you need to have forward-looking data. This kind of rounds out the story, right? You have to go in and ask the question, where's the world around me going? And how do I tie that into my ERM system? So enough about that, but you do need that professional outlook that gives you a sense of where risk is going. And let's face it, nobody could have predicted, I don't think anybody predicted, the pandemic was going to hit, but there were other things going on before the pandemic hit that told us we were on the long end of a credit cycle, that we were into emerging and growing third-party relationships because we were looking at digital delivery, that we were considering higher areas of risk in our compliance areas. These things were all going on before the pandemic hit. And your ERM system needs to identify that for management so that we make sure our controls are appropriate for the level of risk we're taking. And so let's talk about number 3, really quick snapshot. A lot of risk assessments are really good, and we tend to force rank them either by weaknesses or inherent risk or whatever your sort is on your system. I suggest not every question in a risk assessment gets to the heart of the issue. So somewhere in there, you need some sort of free real estate or open writing capability to say, you know what, when it comes to top risk, I need to articulate it. I need to say what it is. And it doesn't spit out of a standard risk assessment. I need to define it. It could be succession. It could be an acquisition coming up. It could be a product launch. It could be excess liquidity. It could be whatever the factor is. You need to have a system that allows you to identify that risk, figure out what the likelihood and severity is, figure out who owns it, where it resides across the risk spectrum of risk categories, what your, at least thematically, what your current controls look like, grade those controls. If your residual risk is higher than it needs to be, then nominate mitigating factors. If your control systems are good, that's awesome. Question asked and answered. But you've done a service for management, the board, and I'll tell you what, I mean, can you imagine showing a regulator that you identified the 5 top things associated with the pandemic, you've conducted a thorough team-based assessment on that, and you deem most of your controls adequate, and in the areas where they're not, you've put together a risk mitigation plan to address it. All right, so take those top risks. If you did nominate some things to fix, figure out what they are, figure out when they're going to be done, and figure out have a tracking system that reports that. Okay, so that takes care of number 3. Actionable intelligence. Everybody's different, so I'm just going to share some thoughts. And again, we started this talking about what's going on with the pandemic and how does that affect our world going forward, and also what are the regulators looking for, and then what do we just need to do if we're one of those banks, whether we're staying, whether we're hunkering down, staying the course, or leaning in. What kind of dashboards do we need? What kind of information do we need to be looking at to serve all of our stakeholders? And my first comment is they should be flexible enough to reflect whatever the bank's business model is. But I would say, number 1, your actionable intelligence or your outputs from your ERM system should record risk movement. And to be honest with you, not really sure I care what mechanism you adopt to do that. What you're seeing samples of here is kind of what the bank's risk appetite is and what the controls look like and where that's going. But I'll tell you what, if my residual or composite risk is higher than my risk appetite, I better start putting on the brakes. Because if my controls aren't adequate, I'm starting to step into dangerous waters. I should have something that helps me track the movement of risk over time, quarter over quarter, year over year, whatever you want to do. Find some KRIs or KPIs that can be measured so that you can say, hey, you know, this is the movement. You know, do we have exceptions? So in essence, what I'm saying is as you look at your information, ask yourself, what is it designed to do? And again, remember, information from ERM is always designed to either stimulate dialogue across the team on risk awareness items or help you make better decisions. So I just kind of underscore that when you talk about actionable intelligence. And that could come in the form of trend lines. It could come in the form of capital. We all know what kind of risk assessment outputs look like. So when I talk about reporting, actionable intelligence, it really is about finding a way to create dashboards that make sense, right? So when you're building your reports, consider what decisions need to be made. And it could be elevated awareness of emerging risk or threats. It could be inadequate controls or weaknesses in high inherent risk areas. It could be trends that reflect, you know, an improvement or reduced risk. It could be your qualitative statements of your system. It could be quantitative. I encourage trying to figure out a way, and whether it's in a report format or on a dashboard, is you should be able to summarize, at least on a top-down system, one page should be able to speak to each key risk category, whether it's operational risk, strategic risk, interest rate risk, but just find ways that communicate ways to stimulate discussion and decisions. So kind of pulling it all together, and this is number 5 about making it manageable. Ensure your ERM solutions align with I say regulatory requirements here because that was the theme of the session, but have a roadmap for what the purpose of your system is. Understand the role of each of the components in your ERM system, so you're not always kind of finding yourself struggling with how to take something to management and to the board. And just remember, they see risk differently, more likely than you do. And so you're also challenged to communicate in a way that makes sense to them. And unfortunately for them, it usually either has something to do with earnings or price per share. So keep that in mind as you're building your dashboard. But again, take a look at those components. Use this as your test. And so I guess what I'm suggesting to you is ERM is, I think, I've always thought it was critical, but I think the pandemic put us on notice that it's an indispensable model to help us identify, measure, monitor, and control our risk. It makes us a better bank. It makes us more sustainable in performance areas, and it satisfies stakeholders that need to be satisfied, like regulators. So as I kind of sum things up, and as you start working with your team, and if you even want to kind of hunt and peck it and build this at your own pace, these are kind of my high level, you know, guidance or feedback for you. Risk appetite's not rocket science, you know, and if you want, we have a little webinar that's recorded that actually is a how-to. And by all means, go fishing around our website or send somebody a question like Robert, our head of sales, and he'll get you that. But if you haven't done it, take your strategic plan, sit down with the senior team, and try to quantify in using that heat map where you think your risk resides, or not where your risk resides, but what you're willing to do or not do. Try to capture it. Build a statement that articulates it in 1 or 2 or 3 sentences, such as if your strategic risk is moderate, it might be because you have above average growth, you're willing to do a bank acquisition, you're interested in adding partnerships to add new product lines. Those are all indicators of risk appetite. What you're doing in technology, how that affects compliance, things of that nature. But go ahead and sit down with your team and see if you guys can pound out. And I've had banks come back to me that have gone through our webinars and they've done it themselves. So these things can be done yourself. And doing a risk assessment process, just come up with something that asks a series of logical questions about key risk categories. And just see how you're doing as far as how much risk resides there. Can you measure your current controls? Bear in mind, without a little assistance in cases like this, banks tend to underrate their inherent risk and overrate their controls. And that's just an internal auditor's world that they have to deal with and test. Do that top risk exercise. Figure out what that top risk is and force rank it. And in this world about responding to regulators, make sure one of them has something to do with the pandemic. And it should probably, right? Tracking and reporting. This is an endless journey, but you know what ERM is. You're responsible for it with your bank. But take a moment and interview and work with the senior team and continue to ask what they need to see from their perspective on what you're doing so that you could continue to fine-tune an instrument that provides stimulating discussion and supports better decisions. And that's an endless journey if you own risk. And then lastly, adopt a system that's manageable, leverages technology, brings you some degree of subject matter expertise, and can be efficient, not a burden. By the way, we're in margin compression times, so I'm actually encouraging banks, and probably selfishly, that this is something that every bank should be investing in, and we're actually asking you to do that in a time when you're probably going through budget hell and trying to cut costs. But ERM implemented well pays for itself 10 to 100 times over, and trying to get out in front of risk. So lastly, my closing thoughts on this whole thing is the pandemic has changed our rules of engagement. The world is different, and it still is. To a great degree, the magnitude of adversity or the adverse impact is still uncertain. But whether it's a regulatory-driven or a management-driven requirement, ERM has kind of come of age. It plays a key role in setting up a repeatable process that supports your ability to identify, measure, monitor, and control the bank's risk. And the interesting thing is, we've talked about adversity up till now. It works in good times and bad, because in the best of times, ERM kind of lets you figure out, how far can this dog hunt? How far can I push the envelope? It's not just about the adverse sides of risk. It's about opportunistic risk that could come in the form of acquisitions or new business lines or entering new markets. It's an integral cog in this day and age of information management. So those are kind of my closing thoughts. By the way, before we get to question and answers, I hope all of you received a copy of the CV Risk Radar. It's a 2-page report, both quarter over quarter and year over year. If you haven't received it, the last page of this, send me a note, send Robert a note at the company. But it's kind of neat. It's a complimentary report we generate for any bank that wants it on a quarterly basis. And it's a nice way to actually track the movement of risk. And you can kind of see it looks at 10 key KPIs. It takes a look at either year over year or quarter over quarter, and it creates a relative risk scorecard for your bank. You may already know this stuff, but I think it captures it in a very useful manner, and it's very useful in terms of management and board discussion. And with that, before I go to questions and answers, I will say, I hope you like the presentation. I hope you'll take a closer look at our ERM solutions. We do 3 things. We are based in Irvine, California. We have bank clients in over 40 states, and we do enterprise risk management, strategic, and capital planning, because they just make so much sense to be together. And I hope you'll take an opportunity to talk to Robert and find out how we can do more for you in that area. So with that, any questions regarding ERM, regulatory requirements, the pandemic? Okay. Well, it appears we hit the high water marks, I hope. Oops, wait a minute. I think I do see something. Okay, several of you have already put a note in there about emailing the slides, so I'll put that as a reminder. For those of you that would like to have this deck and maybe use it for internal purposes, just send us a note, and we'll make sure you get a copy of the presentation. And also, if you'd like to see the Risk Radar report. So thank you for your time. I hope you found this time valuable. And our next webinar coming up in March will be the workshop on developing your risk appetite. And so look for that invitation. Thank you very much for your participation, and everybody have a great day.